Hello, this is David. Welcome to a review of the final chapter that has been assigned out of Andrew Ng's excellent textbook, Asset Management, A Systematic Approach to Factor Investing. And this chapter is chapter 13. It's on illiquid assets. You can see we only have 6 learning objectives here, and we have no calculations actually. We look at some numbers, some research that Ng has done, but it's all qualitative, although there's quite a few concepts here. Evaluate the characteristics of illiquid markets. And one of the things Ng points out is that most assets are in fact illiquid. Illiquidity manifests as infrequent trading, small amounts being traded, and low turnover. Intervals between trades in illiquid markets can extend to decades. So then on the next slide, we have Ng's Table 1 that lists the average intervals between trade and turnover for several different asset classes. So there's almost a hierarchy of average liquidity or illiquidity. Except for plain vanilla public equities and fixed incomes, most asset markets are characterized by long periods between trades, and they have very low turnover. He also points out that even among stocks and bonds, some sub-asset classes are highly illiquid. So for stocks, I think a lot of us think about maybe even purchase and sell the S&P 500, which are large capitalization stocks. Well, that's not the only universe of traded stocks. He says that over-the-counter equity markets, pink sheets, can go a week. Some of those can go a week without trading. The average municipal bond trades only twice per year. And the entire muni bond market has an annual turnover of less than 10%. The real estate market is an example of a huge asset class that is generally illiquid, although innovation is shifting that to some degree. But the typical holding period in the real estate markets is 4 to 5 years for single-family homes and 8 to 11 years for institutional portfolios. So here is Table 1. And what's interesting is that public equities, where the time between transaction is within seconds. I own several stocks or public equities, and I'm still amazed at how rapidly you can buy or exit those positions, where the turnover is well over 100%. But notice we have so many other asset classes where the turnover is far less than 100%, in many cases even less than 10%. So illiquid asset markets are large. Ng points out that the market capitalization of the New York Stock Exchange and NASDAQ, this goes back a few years, was 17 trillion, and that the size of the U.S. residential real estate market is almost that size. He only cited the real estate market, but there to make the point that that's just a real loose lower bound, and would provide the proof that the illiquid asset markets are larger in total than the liquid asset markets. So investors hold lots of illiquid assets because for most people, a majority of their wealth is tied up in their house. 90% of their total wealth is illiquid. And for high net worth individuals, he makes the point that they oftentimes allocate 10 to 20% of their assets into relatively illiquid treasure assets. With respect to institutional portfolios, he makes the point that, well, if we go back in time, it might have been for endowments or pension funds, depending on how far back we go, the allocation to alternative assets or illiquid assets might have been 5%, but that's risen to more like 20 or 25% recently.